we talk about a typical uptrend, we just realize for ourselves it is nothing else but a combination of continuous highs getting formed and continuous lows getting formed. So every single time a high is getting formed, it is always higher as compared to the previous high, what we refer to as a higher high. And in the case of every consecutive low that is getting formed, it is always higher as compared to the previous low, which we refer to as a higher low. Now just realize out for yourself, at any point of time the price stops forming a higher high. As in let's say that in this particular case initially it formed a high, but the next time the price actually kind of forms a low. Let's say this particular low that gets formed is not higher compared to the previous low, rather this low is actually lower as compared to the low that actually got formed over here. Now let's say another high is getting formed. Now this particular high, so this was the previous high, now this particular high as compared to the previous high is lower, so let's call it as a lower high. Now what do you anticipate to happen? So earlier every single time a corresponding high was actually getting formed, it was always higher as compared to the previous high. Now in this particular case the next high that gets formed is lower as compared to the previous high, hence we call it as a lower high. Now if this is a low that is getting formed, earlier if every corresponding low was always higher as compared to the previous low, this particular time the low that is getting formed is actually lower as compared to this particular low. Now I just wanted to convey to you, so as far as a directional intraday trader is concerned or even a swing trader is concerned, these kind of points are what we should be alert of. So these points are actually conveying to us that a possible reversal in pricing or a possible reversal move could actually occur, and that those are the points where we should be eventually setting up our stop loss. Now someone who was trading a breakout out over here, let's say that price is continuously forming higher highs. Now the person could have considered this to be a resistance level. Now the person who would have been watching out these levels would have eventually considered this to be a resistance level, and as soon as this particular resistance level would have been taken out, he or she would have eventually gone for a buy position. Now if he goes for a buy position over here, his perception definitely would have been that the fact that the price would eventually manage to move. Now where should he be setting his stop loss? A good place where he or she could set up their stop loss would be at this particular swing level. So he or she could have set up their stop loss over here. That is, they felt that okay, this high is getting formed, a high is getting broken, or this resistance level is getting broken, that could eventually drive for a further upside move, and his or her stop loss could have been set somewhere below this point, because at any point of time, on the other hand side, if the price manages to drop below this particular point, something that was initially forming highs and lows, at any point of time it manages to break below this particular point, it could be the start of a new downside move. Or in simple words, if the price breaks down below this particular level, that is actually below the high point from where we checked out for a breakout, that could be the potential start of a further downside move, and it is safest for us to exit exactly when the price actually manages to break below this lower level or where we keep our stop loss, rather holding on to a trade that is eventually reversing in its trend of our initial perception. Now on the other hand side, when we speak about a typical downtrend, it is nothing else but a combination of lows getting formed, highs, again consecutive low, again high, low, and so on. So this is a low, this is a high, this is again a low, this is a high. So what is very interesting out over here is every single time a low is getting formed would be lower as compared to the previous low, and every high that is getting formed would be lower as compared to the previous high. Now this is also a lower low and this is a lower high. Now let's say that I'm going to go for a short position out over here. So let's say that I'm actually going to take a short position over here based on this particular swing low getting taken out. So I'm anticipating okay, the price could manage to move towards the next significant level that maybe lies somewhere over here. This is the nearby support level where the price could manage to head up to. If I enter the trade out over here, the next question would be, where would I keep my stop loss? The most obvious answer is I can actually set my stop loss a bit above this particular level. That is above this particular lower high, I can actually keep my stop loss. Now what is the rationale or what is the reason behind it? It is pretty simple. At any point of time, after breaking this particular low point where we entered the trade, based on the breakout of which we entered, if the price is eventually managing to pick up above these particular levels, that could be a trigger conveying to us that a further upside move could potentially come in, or a further reversal could actually come in, which is going to push the price further up. So we can simply set our stop loss somewhere over here. In simple words, this would be the point where our view changes. So as long as the price manages to trade below this level, we can hold on to the trade, and if at any point of time the price manages to pick up above these levels, we could kind of completely reverse our view and set our stop loss over here. So in simple words, here also we are setting up our stop loss at a point for a short position. We are starting off with a short position. We are setting up a stop loss in such a way that according to the structure of price, if the price manages to pick above this level, our view turns bullish. So if you are starting off with a bearish view, set your stop loss at a point where your view turns out to be bullish. If you are starting off with a bullish view, set your stop loss at a point where your view turns out to be bearish. As simple as that. So we have realized out for ourselves, just knowing the trend really doesn't matter, but also anticipating how much of a potential move could come in and then riding on to the same, that is what is important in the markets. So I just wanted to convey to you, so every single time if you are checking out for a directional trading opportunity, so from my personal experience, the systems that we personally follow, as mentioned earlier, gives us a hit rate or an accuracy of around 60%, 40 to 60%, that's it. So that is, if we perform 100 trades, it is just going to be 40 out of 100 that is going to win. So let's always consider the worst case scenario when we are sampling out something. So it's just going to be 40 out of 100 of your directional trades that is going to win, and the rest 60 out of 100 is going to fail. Now I know there could be some of you who would be having a perception that I'm getting an 80% or 70% or 90% accuracy, but trust me, your sample set is too small. And from my personal experience, like when you're kind of studying any particular setup directional for a larger duration of time, definitely your accuracy is going to be more or less around 50% itself. Okay, so now don't think that good traders, they have a 90% accuracy and bad traders, they are the ones who get a 50%. So in fact, it is how you manage the risk that is going to help you in the long run. So getting a 90% accuracy over a 1 week duration of 4 trading days doesn't mean for the rest of your life you're going to get the same hit rate. So it depends on the market conditions also. But generally speaking, you can get something like a 40% for most of the working directional trading systems. Now, if you ask the reason why is that it is just 40% for directional trading system, just think about this factor. So what percentage of the markets are trending? So if you have 100 trading days, so more or less it is just going to be 70 days that is going to be, it is just going to be more or less 30 days. It's going to be more or less 20 to 40 days that is going to be trending. So on average, we can consider 30% of the days are going to be trending, and the rest 70% are going to be non-directional. So that is the reason why you are getting a lower accuracy when it kind of comes to directional trading systems. Now, if on any particular week the markets are really much trending, definitely your directional trades are going to yield you very good results. Now let's consider this to be one of the confluences of the major 3 factors that we could actually look into when it kind of comes to taking a directional trade. So first and foremost, your risk reward ratio should be at least 1:2. That is, your first potential reward should be at least 1:2, where you're risking 1 rupee for looking out to make 2 rupees. So even if you have a 40% accuracy, let's say you're trading 100 times, 40% of the times you win. So every 40 out of 140 trades you're winning, you end up making 40 into 2. And every 60 trade, for the 60 trades that you lose 60 into 1, that is 60. So net on net, still you would be having a 20 points, that is 80 minus 60. Now some of you would be having this query, so what about charges and all these things? I have not considered any charges, all these things. Now, one more thing I just wanted to convey to you is, So when you are kind of trading directional, so even though we kind of took the worst case scenario that our hit rate is going to be 40%, there could be times when your hit rate is actually going to be 50%. And there is also going to be a scenario where you are capable of capturing more than 1:2. Okay, so right now at this point of time, capturing 1:2 in equity intraday is very difficult. And I personally check out for swing opportunities in equity. That is looking more reliable for capturing something like a 1:3, 1:4 and all. It is definitely possible. So equity intraday 1:2 is also very difficult nowadays. Okay, so in simple words, check out for systems with a risk reward ratio of at least 1:2. Now what to do next? Now, even though I considered or we considered out 1:2 out over here, I just wanted to tell you 1:3 is always better than 1:2. Now if you're getting something like a 1:4, that is definitely a trade that you should definitely be willing to attempt. Okay, so higher the better the risk reward ratio, the better it is for you as a directional trader. Now there could be even scenarios. Now some of you would be still wondering, okay, accuracy is just 40 or 50%. Okay, risk reward, I suppose now you are capable of understanding. Now what are the other methodologies that we could eventually use to maximize our winners and kind of cut short our losers further? Okay, now this is a discretionary approach. Discretionary approach in the sense it is completely your mind that is going to take decisions on what to do, when to do, etc., etc., and the results could be varying from individual to individual. Howsoever, I just wanted to convey, if you have a system with a 1:2 risk reward ratio that has a 50% accuracy, still you can actually be ahead of all the still you can be in the top 10% of the traders if you can stick with your emotions and stick with your trading systems following 1:2 ratios and a system with a probability of like 50%. So some other methodologies that one could actually use is, so let's say, okay, let's assume this is a system with a 1:3. Okay, that is let's assume my risk is like 2 rupee and my target is like 6 rupee. That is a 1:3. Okay, so I'm kind of putting this as 3R and risk is 1R. Okay, now what if I know, okay, this is a 1:3 system, the accuracy of my system, let's say, is just 40%. That is only 40% of the times I'm being right. So initially itself, if the price has given some sort of a move, let's say that I have already realized my 1:2. Okay, I was anticipating a 1:3, but right now the price has given a move equivalent to 1:2. That is, it has given a 4 rupee move for the 2 rupee risk that you have taken. Now if you consider, 1:2 itself is a good risk reward ratio and you have managed to kind of make more than double of what you have risked. So there are multiple things that you can think about doing now. So first and foremost, one of the methodologies that I personally love is that I think about mitigating my risk. So these methods can be done in intraday. So as far as swing, you need counter positions or you kind of need to keep some sort of hedge to do it. All these things are needed, where you could actually think about locking in your profits. Okay, you can think about locking in your profits or making your trade risk free. I'll just quickly explain how that can be done. So let's talk about intraday because that is much more easier to explain. So initially, if my stop loss was kept somewhere over here, and let's assume that I was trading 100 quantities. I was trading 100 quantities and initially my stop loss was actually kept over here. So as soon as the price has given a 4 rupee move for the 2 rupee risk that I have taken, I may think about maybe booking 50 quantities out over here. That is, initially if I started with 100 quantities, if I bought 100 quantities over here, I can think about exiting 150 quantities over here. That is, half of my positions I'll book profits over here and the rest of the positions I may think about modifying my stop loss and keeping my stop loss out over here. So now what happens? So even if the price now falls down and hits my stop loss, still I can end up the trade in a positive 1 hour. I'll just give you an explanation. So we talked that, okay, our stop loss, initial stop loss is 2 rupee and our target is actually 6 rupee. But at one point of time, the price has given a move of 4 rupee. Okay, so 4 rupees profit we have kind of achieved. Price has given a move of 4 rupee. Now what can be done? If I entered with 100 quantity, then the risk I would have taken in this trade would be 2 into 100, which is nothing else but 200 rupee. So as soon as the 100 quantity has given a move of 4 rupee, my profit is like 400, right? So instead of booking all the 100 quantity, what I'm doing is I'll book 50% of my position. That is 50 quantity I'll book at a profit of 4 rupee, which means I will be making 50 into 4, that is nothing else but 200 rupee. So what happens? So whatever I have risked, I have been able to secure that or capture that by booking just half of my positions over there. Then what will I do? I may think about, so this is completely discretionary. Now if my view is okay, market is going to be really bullish further, I may think about bringing my stop loss to above my entry. That is at my entry point itself, I'll bring it. So what happens? Now if the price comes down and hits my stop loss, it is just the rest 50 quantities that is going to be exited with my trailed stop loss. This is what we refer to as a trail stop loss. So with every significant move, you can think about considering to make your trade completely risk free by trailing off your stop loss. So if you trail your stop loss, your trade becomes risk free. And now even if the stop loss hits my, even if the price hits my stop loss, still I have been able to book this 200 rupee profit. Now let's say a better scenario. Let's kind of actually assume that, okay, now the price has eventually managed to go up to 3R. That is 6 rupee move is being captured by this particular stock. So 50 quantity I book with a 4 rupee profit. Now I may think about booking the rest 50 quantity with a 6 rupee profit, where I eventually make 6 into 50, that is 300 rupee. So what is my net profit? I would still be managing to make like a 500 rupee profit by risking the same 200 rupee. Now there could be even scenario when the price reaches 3R, or once the price gives a 6 rupee move, you personally feel, okay, now maybe it is going to give an 8 rupee move, or it is going to give a 10 rupee move, because the stock is looking really bullish. Maybe the index at that point of time is also really bullish, and etc, etc. So you may think, now if you have 50 quantity with you, you may think about holding on to the complete 50 quantity for achieving the 4R or 5R, or you may think about booking maybe 25 quantity at a 6 rupee profit, and you can hold on to the rest 25 quantity looking out for a 8 rupee target. So this is completely discretionary. So these are the methodologies that you could actually use to ride on to your winners.